So the corporation is also another form of business that you may want to consider. An important landmark decision, Dartmouth College versus Woodard, was important in establishing what a corporation is. And there, you can click on that link and it'll take you to information about that legal battle. And it'd be interesting to read up on exactly how corporations came about. That happened in 1819 and kind of set the precedent for a lot of different things. Corporations make up about 15% of all the business in the United States, but they do account for about 80% of all the dollar value in business. So they're doing a majority of the businesses out there in the real world. There are a small percentage of them actually in place. It's only 15%, but as you can see, they create a lot of dollar value in the business world. So to go into a little bit of depth on the Dartmouth College versus Woodard case, Chief Justice John Marshall stated that a corporation is an artificial being, invisible, intangible, and existing only in the contemplation of the law. This is a pretty important decision. So what does it mean and what are the implications of that decision? It basically means the Supreme Court encouraged the development of private colleges and universities by protecting them from state management. And also, this kind of led into private donors were more stimulated to put in some money in toward the colleges. So corporations have stakeholders or stockholders, whatever terminology you would like to use. These stockholders must agree on the name of the business, the number of shares of stock the corporation can sell, and the number of shares of stock each of the owners will buy. So that has to be determined right up front when you start on a corporation. The number of shares this corporation will have total, and the number of shares of stock each of the owners will have what they'll purchase. They also need to establish the amount of money or property each owner will contribute to buy his shares of stock. So you don't necessarily have to have money, but there has to be some kind of contribution, usually either money or property, in order to get these shares of stock. The business in which the corporation will engage has to be agreed upon. Usually this is not a problem. Usually people know right up front that we're going to create a business for the specific purpose, but know what that purpose is, know what where the limits are to that engagement in different types of business. Usually right up front you want to decide who will manage the corporation, and this all varies. All these things vary state by state. Corporations, the structure, how they're managed, how they're set up vary state by state. So within a corporation structure, there are certain fees that need to be paid to the state. And this is based upon the number of shares of stock authorized and the value of the stock. Other fees may apply when dividends are given as well. So there needs to be a set of bylaws in order for a corporation to be created. This has to be upfront. It has to be before anything else is done as far as creating the corporation. This is part of the creation process. A corporation is a legal entity separate from its owners. So for a proprietorship and a partnership, the business was the partners. It was the person. Here, a corporation is a legal entity separate from its owners, and therefore, by law, has to have a separate bank account and separate financial records. Now, before, I encouraged you to have separate bank account and separate records for the sole proprietorship or for the partnership, but that wasn't a legal requirement. That's just good business practice. Within the corporation, we must have separate financial records and separate bank accounts. It's law. So you want to determine who has control of your corporation. In general, those who have a majority of the shares have a majority of the control, and they can elect the board of directors. Now, we haven't really discussed the board of directors yet, but board of directors make the major decisions. They give guidance to the corporation. And this could be in a variety of capacities. Generally, the day-to-day decisions are made by officers within the corporation, such as the CEO, the CPO, certain managers, so on and so forth. But the larger decisions, the guiding factors, are usually made by the board, and the board is made up of people who are elected by the people that have the shares. So if you have more shares, you have more control. Then you want to discuss liability. So it's its own, this corporation is its own legal person. And so it's separate from its owners. So individual shareholders are not personally liable for the losses of the business. Now this is a big difference. So if the company completely tanks, as a shareholder, I am not legally responsible for it going downhill. I may lose out on what I've invested, but beyond that, I'm not legally responsible for much at all. That's the benefit of a corporation. So how does a corporation continue, and what's the transferability of a corporation? Basically, a corporation will last as long as the shareholders decide it should last. Transfer of ownership can be done by the sale of the stock. So if I sell all my stock to a different person, legally I'm no longer claiming an ownership in that corporation and somebody else is. It's fairly easy to remove oneself by simply selling the stock. The taxes are where it gets a little bit different from the sole proprietorship and the partnerships. Basically, we're moving into the area of what is known as quote-unquote double tax on the corporations. So the corporation files its own income tax return and pays taxes on its profits. So it's taxed once as an entity in itself. Remember, the corporation is its own entity. When the corporation pays dividends to shareholders, those shareholders pay taxes on those dividends individually. So you've gotten taxed again on that. So that's where you get your double tax on the corporation. So if you look at the slide, you get a general idea of what a corporate structure may be like. So you've got your stockholders or your shareholders at the very top. These are basically maybe called the incorporators, but they basically elect the board of directors, and the board of directors' purpose is to represent the shareholders. So depending on how that's done, the board of directors can have a completely different makeup between different corporations. The chief executive officer, whatever name you use for that person, it's the person that is in charge of the entire business operation. That person reports to the board of directors. Within that structure, they supervise people like the vice president of operations, the vice president of marketing, vice president of personnel, so on and so forth. Basically, there's usually a few people that is supervised by the CEO or the CPO, or however you want to term that. And from there on out, it trickles down. So basically, the whole point is here is the CEO reports to the board of directors, and the board of directors are there to represent the shareholders, their best interest for profits and limiting losses and liabilities. Okay, so what are the requirements for starting a corporation? First, there's a licensing fee. This basically gets you started. Then you have to come up with a name for your corporation and an address for your corporation. So your corporation has to exist somewhere, and it has to have an address. Then you come up with an articles of incorporation and operating bylaws. And this is really the nuts and bolts for the contract for beginning the corporation. So then within that, you decide what kind and duration of your business, what kind of business you'll be conducting in the duration of the business or the corporation. The shareholders will decide on the maximum number of shares of stock. They'll also decide on the par value of the stock, what's the general level value of the stock. And remember, again, this all varies state by state. Different states will have different specifics on how you are required to set up your corporation. So 3 important things to remember when you're starting your corporation. First, there are different persons involved: incorporators, stockholders, directors, and managers. And each of these persons have specific roles and responsibilities in the corporation and make decisions within the corporations that are that vary from their different roles, within their different roles. Number 2, corporations are independent entities. They are taxed as independent entities, and they hold legal status as an independent entity. 3, corporations may own other corporations. So at any time, your corporation may be purchased by another corporation, or your corporation may purchase another corporation or begin one within one of those structures.